Which brings us to our next guest analyst. Why don't we bring him in, Mr. Craig Bolanos. He's co-founder and wealth advisor at VestGen Wealth Partners. Thanks for being on the show, Craig. I really appreciate it. Kind of give us what's top of mind for you today. I mean, what are you looking at? What do you think about these markets? Boy, it's been one heck of a comeback. It's almost like Liberation Day 2.0.
Yeah, it feels like my second round trip around the sun, and I wasn't even on the Artemis 2. So here's what I'm thinking about. Scott, I'm saying to myself, I think the bottom from the war is in. I mean, maybe with hindsight now, that's an easy call. I thought we might have had to trade down into that 6250 range on the S&P contract. Didn't quite get there, but you can make a compelling argument that next stop is 7200, and the stop can be even higher after that, despite the fact that we have this midterm election year with traditional volatility. But before somebody goes all in, oil and the Treasury market hasn't yet confirmed this rally.
You're right, because the Treasury is around 4.3%, oil still around that $90 a barrel issue. Where do you need to see those things to kind of give you all green lights, full systems go?
Well, if the all clear sign was signaled by the Treasury market, I'd see us trading, 20 to 25 basis points cheaper. There's still a war premium, which is
Yeah.
ultimately an inflation premium in the Treasury market. And I wouldn't expect, WTI, West Texas Intermediate, I wouldn't expect that to be back down in the 67 range. But boy, it would make an awful lot of sense to me if all was good that we'd be in the mid to high 70s right now, but we're not. So that tells me that not everything is handled. That being said, I thought it was really interesting how this time around institutional money was legging into this market during the VIX, where retail
Yes.
money was actually de-risking. That's the opposite of what we've seen in these previous events the last couple years.
Yes. Yeah, you're exactly right. That's the case. I mean, when we had Liberation Day, April the 2nd last year, and we sold off hard in April the 8th, it was a lot of the retail investors that really were the beneficiaries there, where we had a lot of the hedge funds running for the door. I mean, you're right. That's what I've seen this time around, too. So having said all that, it does feel like, though, that the equity market's looking through it all and looking at the good news, because there is good news out there. I mean, look at our earnings, look at the margins, look at the jobs, look at the tax rebates. There's a lot to be happy about when it comes to the U.S. economy, especially as compared to the rest of the economies around the world. Right now, we're doing pretty well.
We are. I mean, just this month, just the other day, the Empire State Manufacturing came out, upside surprise. Philly Fed came out, upside surprise. Those are two data points for the month. And it is earnings season, as you alluded to. And companies are always beating, but companies are beating by a better margin. I think that's important for people to pay attention to, that earnings have not been destroyed. Consumer confidence, utterly terrible, regardless of what survey I look at, University of Michigan or any of the others that are trying to take the crown. And I just don't know when that's going to come back. It's not a matter of if, I think it's a matter of when, but it's something to pay attention to, because anytime two lines diverge by too much, they have to come back together. And what I'm referring to is my metaphor for the K-shaped economy. So at some point in time, Scott,
Exactly.
this divergence got to come back, and there's different ways it can come back together, and we should all be thinking about such. But I don't believe that's going to be the case in spring and summer of 2026.
Now you're so right, Craig, and that's a big worry, and it is a bigger issue than I think a lot of people are making out, because we've had some guests on the Cow Guy Close who explain it pretty well. But if you look at that K-shaped economy, where the upper 20% of incomes are doing well, while the lower 80% struggle to kind of get their footing, the lower 80% of incomes are starting to resent the upper 20%. That's a problem. You need to see those Ks come, those legs of the Ks come together, where there's a little bit more of the lower 80% benefiting from what's been happening with this economy. And I think that the president's on the shot clock going into November to kind of get something at least moving in that direction, because he can't fall in that trap of trying to tell you how you should feel, like Biden did, because that was a disaster. You have to show these folks how they feel and put it in their pockets, right?
You know what? People need to feel the love, which means they need to see it and they need to be able to touch it. And in addition to that, there still needs to be something. There needs to be something for everyone to coalesce to, everyone to rally and be inspired about. That's always been the magic elixir when it comes to presidents, when it comes to leaders of this country through the electoral process. So we'll see what happens. But, I'm optimistic still about one thing. The big secret I've been kind of letting out to people is a secret from the last couple years, Scott, as I lean in. The U.S. economy is clearly stronger than consensus believes. Shh. Well, I guess we just
Oh yeah.
told lots of people who are watching this TV show.
Well, the only thing that I think we need to clean up, and it will happen, I think, when the war is over for good, and we're well and truly done with it, and there's a lot of oil flowing in the straits. Is the last thing that I think there's probably a really big black mark on our report card over the last 6 weeks is this consumer confidence number that came out the worst since they've been taking that reading, the worst in 74 years. That also is another thing that the president's got to work on, and I think this higher stock market, more rebates, no tax on tips and the likes. A lot of those things will go a long way to help, but that's something that we need to pay attention to because we're 70% of this economy is run by the consumer.
Yeah, absolutely. It is mission critical that we build from the bottom up right now because everybody on the top side pretty much has the most they've ever had at any point in time in their life. So financial security has been achieved. It's just we have to discuss what's the best pathway to go ahead and become, a little bit, I don't know. How do you build it, Scott? I guess that's the ultimate problem. How do you build it? But my message for investors, real quick, on a Friday is this. Remember, you always get a second chance to do the right thing. I'm not talking about Fibonacci retracement levels, Scott. That's for the traders. I'm talking all the investors out there who are so overweight technology, so overweight stocks relative to the long term health of their financial plan. If you ever wanted to rebalance, you just got a second chance to rebalance some money at all time highs. Let's get it done so we too can stay retired once you've gotten retired. I think that's a key message because complacency doesn't belong for anybody.
Yeah, you're right. I mean, you got to be, that's just complacency is, being a little lazy too. There is a fair amount of responsibility on everybody to make sure that they've got something ready for when they need it down the road. I really appreciate you coming on. Always great to have you on a Friday, Craig. Have a great weekend. Thanks for all you do.